Just like many things that are somewhat complex, you need to learn the basics first before moving on to the heavy duty stuff. Reverse mortgages are no different. I see people trying to understand the more complex aspects to the loan before even getting a basic understanding of the underlying mechanics. This is like building a house with a shoddy foundation. It leads to confusion and makes it much more difficult to grasp the more nuanced aspects of the loan. So that's why today we are bringing it back to the basics. And in this video, we're going to go over those basic mechanics of how a reverse mortgage works. So stay tuned. Hey everyone, if you don't know me yet, my name is Taryn Proctor. I am the president of Retirement Home Equity Advisors and am your go-to resource for everything that has to do with reverse mortgages. I exclusively specialize in reverse mortgage financing and have been in the reverse mortgage space since 2015, and I've helped hundreds of clients through the reverse mortgage process and have educated thousands of folks about how this loan works. Point is, I like to think I know a bit about reverse mortgages and want to teach as many folks about what I deem an incredible loan product that has the capacity to and has helped many folks better their retirement. So I hope you learned something today. And if you do, all I ask is that you hit that thumbs up button below and like the video. As well, if you want to continue learning more, go ahead and hit the subscribe button in the bottom corner of the video and subscribe to the channel. Turn those notifications on as well so that you get notified when we have more educational videos come out, which I try to do at least once a week. So now that we have that out of the way, let's get back to reverse mortgage basics. Now, in the most simplest of definitions, a reverse mortgage is a mortgage that allows seniors aged 62 or older to liquidate a portion of their home's value and does not require monthly principal and interest payments on the borrowed portion of the loan. That is to say that with a reverse mortgage, there can be a borrowed portion and an unborrowed portion, which we'll get into that a bit later. But all the while, a reverse mortgage does not require you sell or give up ownership of your home. Now, how this works is your age, or if you're married, the youngest spouse's age, plus what your long-term interest rate is projected to be, will determine what percent of your home's value you can liquidate with a reverse mortgage. So for instance, let's say your age and long-term rates determine you qualify for 50% of your home's appraised value. So that means if your home appraises for $500,000, you would qualify for 50% of that, or $250,000. Now, depending on your age and current long-term interest rates, folks right now will qualify for a wide range, anywhere on average from 35 to 60% right now. And a very important piece of this that I hope you all remember is that the percent of what you qualify for can actually change from week to week, because that percent is based in part on long-term interest rates, which can change weekly. And what happens is when these rates rise, everyone qualifies for a lower percent. But also when those long-term rates go down, the amount you qualify for goes up. Now, although what you qualify for can change from week to week, when an application is created or completed by the loan officer of your choosing, if you ever get to that point, you will get locked into the percent that you qualify for in that particular week. So that is to protect you in case those long-term rates rise during your loan transaction, ensuring the percent that you qualified for initially doesn't go down in the middle of the loan process. So now that we have our estimated loan amount, which if you remember, we were saying 50% of a home that appraised for $500,000. So making that $250,000. That $250,000 represents your reverse mortgage loan amount. But again, just because that is the total loan amount that doesn't necessarily mean that whole amount is going to be the borrowed portion. Now, the first thing that will happen with that money is if you have any liens or mortgages on the house, those will need to be paid off. Next, closing costs come out of this loan amount as well. Closing costs on a reverse mortgage are generally not something that you have to come to closing and pay out of your pocket. They're rolled into your reverse mortgage loan. So if we go back to our $250,000 loan amount and assume your current mortgage and closing costs equate to $150,000, that means that $150,000 will be taken out of the $250,000, leaving you with $100,000 left over. At this point, because the reverse mortgage pays off any other current mortgages, you now no longer have a required principal and interest payment. Your old mortgage is replaced with the reverse mortgage, and now you have the option to make a payment or not. So if you choose not to make a payment, which most folks do, then what happens is your loan balance will begin incurring interest, and that interest will just get added to your loan balance month over month, year over year. To break this down a little bit further, think of how a regular traditional mortgage works for a minute. On a traditional mortgage, you are forced to make a payment every month. That payment every month goes to first pay the interest that you've incurred for that particular month. And second, it goes to pay down your principal balance little by little. So on a reverse mortgage, if you choose to no longer make those monthly payments, that interest that is paid monthly on the regular mortgage will just begin to add on to the loan balance over time. And at some point in the future, when the last remaining borrower leaves the home, either due to death or selling of the property or something like that, that is when the loan balance and all of the accrued interest would need to be repaid in full. So now you've paid off your regular mortgage, and remember we said you had $100,000 left over after paying the mortgage and closing costs, which means at this point, you no longer have a required mortgage payment and will be able to have that additional cash flow every month, and you have the extra $100,000 that is yours to do with what you want. Now, it is at this point that things get even more interesting and beneficial, because we can structure that additional $100,000 for you in a number of ways that can be very strategic and beneficial. We won't go into those specific strategies or the specific benefits today, but you can certainly check out our other videos that go into detail about this, or you can always feel free to reach out to me and I'd be happy to go through your options with you. So our options as to how to structure that additional money would be either setting up a line of credit for you to have that money sit in if you don't need it right away. And you can pull that money out over the years as you see fit. You can also take that money in a lump sum, or we can also structure that money to be given to you in monthly payments. We can also do a combination of all of these things. One of the most important aspects to note here is the money that is available to you that you don't pull out, you will not be charged interest on. The money you leave in the reverse mortgage to be used at a later date is considered an unborrowed portion of the loan. And you are not charged interest on any unborrowed portions of the loan. Reverse mortgage proceeds are not considered borrowed until the money is actually paid out to you or for you on your behalf. And furthermore, any proceeds you receive from a reverse mortgage are 100% tax-free. This is extremely helpful when it comes to saving interest over the life of the reverse mortgage loan. And contrary to a cash out refinance, whereas on a traditional cash out refi, you take all that money at one time, even if you don't need it all at once. And you're charged interest on the total amount. And then you have a forced monthly payment. So now with a reverse mortgage, you've paid off your regular mortgage and no longer have a required monthly principal and interest payment, although you can make payments if you ever want to. and you have an additional $100,000 that you can do with what you'd like. And again, all the while not having to sell or give up ownership of your home. And these are the basic mechanics of the reverse mortgage. We went over loan amounts, borrowed amounts versus unborrowed amounts, how the loan balance progresses over time, and how the loan amount gets paid out initially. So I hope you learned something new today. And if you have any questions, I'm always here to help. Don't be hesitant to reach out if you have any questions or want to see exactly what your reverse mortgage options look like. We're currently licensed and able to help folks in Arizona, California, and Colorado. And don't forget to hit that like and subscribe button so I can look forward to seeing you next time. Thanks for watching.